Hi, Steve Sosnick here with today's Interactive Brokers Morning Market Morsel. Today, Monday, the 15th, what we're seeing is more of the consolidation after the wild moves of the last week. The rally on Friday, I guess, shouldn't be too surprising. We'd had such sharp sell-offs Wednesday, Thursday. You can argue that we were, if not seeing the levels where you might expect a selling climax, you could sort of expect some buying on the dips after such a sharp decline. A lot of the major indices remain right around their 200-day moving averages, and that's a level that will not go quietly, and that's, I think, why you're seeing the bounces around there. And the question is, are we consolidating, are we bouncing, or just taking a pause on the way down? That's the sort of thing that won't resolve itself for quite some time. What I think you don't want to see is a series of consecutive closes below the 200-day moving average on your major indices. Let's use SPX, NASDAQ, and DX, even Russell to a certain extent. You don't really want to see that because that's used by technicians to justify a move. A lot of times if you say there's support, you don't want to see two or three closes below the support level, or you might argue a breakout as if you see two or three closes above a resistance level. So 200-day has been very steady. And it's really been pretty much the guiding trend of the market for the past 2 years, roughly. So it's not unusual to see the markets trying to find the level around that trend line. And I think you should be trading accordingly. I think this is a time to either be nimble if you don't have strong convictions, or use your strong convictions if you have them. I think right now the crystal ball isn't particularly clear. So I think it probably behooves you to be more nimble than dug in. We're still seeing the VIX trading above 20, which means that the market's not exactly sold on the fact that Friday's rally was a return to the more normal levels that we'd seen over the past years. Remember also, by the way, that those levels of the volatility were historically quite low. So that's there as well. You really have the interesting backdrop now of stronger economy, Fed working against that in many ways, and in doing so, providing alternatives to equity investments that we really haven't seen for quite some time. This is really quite an interesting saga. Think of it this way. You've had almost 10 years of unprecedented Fed easing. You can't expect that we're going to have an unprecedented unwind of that easing without a couple of hiccups along the way. I think we're seeing one of them now. Take care. Bye.